Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope I find you very, very well today and everything has been good. Sorry for not being here last week. We had a big rebrand at MFB. Very, very exciting for those of you who haven't yet gone and had a look at our website. It really has had a huge facelift. It's absolutely wonderful. The feedback from people who have been on there and had a look has been really positive. Bridging calculators, you can sort out your general insurance on this, your landlord's insurance, life cover, all sorts of really great stuff. So do go and have a look when you have a moment. But more importantly for now, what we have for you today, we're going to do our usual roundup of what's been happening with interest rates. I'm sure you would have seen lots of chatter in the press in terms of lenders cutting rates and all this kind of stuff. So we're going to delve into that a bit more deeply and find out what's going on and what's going to be likely to happen going forwards. We're going to touch on inflation. The news on inflation came out in the previous week. I do want to speak about that briefly because it's important. We're then going to talk about the latest data released from the ONS with regards to rents. And then finally, we're going to touch on what's happening with house prices according to those very savvy people at Knight Frank. So first up, it wouldn't be an MFB News if we didn't talk about what's been happening with swap rates. And if we rewind to our episode 2 weeks ago, we were talking about the fact that swap rates had really come right down and we were seeing loads of lenders repricing. Now, sort of towards the middle, I would say, of last week, we started to see swap rates actually edge back up again. And I suspect this is, first of all, in response to the news about what's going on in the Red Sea. There's a real concern there in regards to how the goings on there could impact the cost of oil, as we all know. If the cost of oil increases, then that basically increases the cost of absolutely pretty much everything. And this then kind of have a negative impact on inflation. We then got the inflation news as well, which we'll go on to in a bit more detail shortly. So in essence, what we saw is the swap rates increased by, at one point, it was about 30 basis points. Where we are as of this morning, so 2-year swaps are at 4.259, 1 month ago, 4.043. So you can see they've gone up by around 0.2%. 5-year swap rates, 3.698. 1 month ago, 3.599, so circa 0.1% higher. So in terms of the impact this has had on mortgage pricing, so it's been a mixed bag actually, and we'll go into this in a bit more detail when we start to get into what the lenders have been up to. But we have seen lots of lenders continue to reduce rates. Now, a lot of these are lenders who actually hadn't reduced their rates initially, so they had lots of kind of bandwidth to be able to make reductions. But we've also seen some lenders continue to reduce pricing as well. These guys are obviously able to take maybe a greater hit on their margin, or they're kind of funded not just from the capital markets, but maybe in different ways as well. So they're not quite as kind of open and susceptible to fluctuations in swap rates. But we've also seen a couple of lenders have to withdraw some products and push them up as well. So it's been a bit of a mixed bag. I'm going to go into that in a bit more detail with lender pricing, but that's really what's been happening with swap rates in the last fortnight. Okay, so moving on to lender rates, and I won't give you everybody's rate changes for a fortnight because we'll just be here all day. But in the last kind of week, what we've seen is Virgin make reductions, Skipton have made reductions by up to 0.4%. We've seen TMW bring their rates down in the personal and actually to some extent in the limited company space as well. Their pricing is absolutely exceptional. Rates there are now from 3.54%. We've seen TSB make reductions to their products of up to 0.7%. TSB hadn't made any reductions. This is one of the lenders who's made their first kind of step down since the large decrease in swap rates over Christmas. In the more specialist end of the market, we've seen Precise make reductions to their rates. Again, they were a lender who hadn't made reductions previously. 2-year rates from 4.19 and 5 years from 4.29%. TML rates down by 0.3. Kent Reliance rates have gone down 2 years from 4.29 and 5 years from 4.39. Again, as always, guys, just be very, very mindful of the arrangement fees on these lower kind of deals. We've seen Aldermore reduce rates by up to 0.5%, and the Market Harbour also reduced their pricing by up to 0.5% as well. So actually, most of those lenders, just looking at the list, hadn't made reductions previously. So while we are still seeing lenders making reductions, it's broadly those lenders who hadn't reacted or made adjustments in the wake of swap rates coming down significantly over Christmas. So these guys had kind of a lot of wiggle room around their pricing to be able to make reductions. Now, conversely, we have seen a couple of lenders do some changes. And so actually what I would say is they haven't necessarily repriced upwards, but they've withdrawn some of their limited edition products. So what lenders tend to do, or some lenders do, is they'll have a set of core products, which are like their standard rates, and then they'll kind of introduce what they call limited edition products. And this is where they're essentially releasing a deal which is more competitive than their standard range in a bid to kind of drive in some new lending. Now, these are the products that lenders are actually withdrawing at the moment, and we've seen Paragon withdraw quite a few of their limited edition products, and also West One. And I guess the rationale for this would be simply that actually, because of the increase in the cost of funds on the money markets, these products no longer make commercial sense for them to be available. So it is a bit of a mixed bag in terms of who's doing what, but actually broadly, as you would have seen, more lenders have come down this week than gone up. So I suppose that's a positive, and let's just stick with that for now. In terms of how pricing is now sitting, so personal borrowing, so 2-year fixed rates are from 3.06%, but with a 7% fee, 3.54% with a 3% fee, and if you want a lower fee than that, obviously the rates just kind of increase from there. 5 years are from 3.79 with a 3% fee. In limited company lending, 2-year fixes from 3.06, again with a 7% fee, or 4.69 with a 3% fee. 5-year rates from 4.29 with a 7% fee, or 4.89% with a 3% fee. And again, there are deals with lower fees, but the interest rates would be higher, above what we've just mentioned essentially. So that's kind of what's been happening with the lenders in the last week. Okay, now just moving on to inflation, because that kind of obviously links in very kind of nicely to what might happen with interest rates. So you would have seen, I'm sure, in the press in the last week that the latest ONS data revealed that CPI inflation rose by 4% in the 12 months to December 2023, and that was up from 3.9% in November. And that's the bit I think has really set the cat amongst the pigeons. So people were not expecting to see an increase by any stretch of the imagination. So that has caused some real kind of concern. So on a monthly basis, CPIH rose by 0.4% in December 2023, the same rate as in December 2022. And just for those of you who find these numbers kind of slightly confusing, CPIH inflation also includes occupiers' housing costs. Okay, so that's the kind of difference between normal CPI and CPIH. Now, the largest upward contribution to both CPIH and CPI annual rates came from alcohol and tobacco. The largest downward contribution came from food and non-alcoholic beverages. Now, core CPI, which is the other one that people watch very closely, which excludes energy, food, alcohol and tobacco, which means it's slightly less volatile, rose by 5.1% in the 12 months of December 2023, and this is no change from November. Now, industry experts, as it were, have been kind of split in terms of what this means for base rate going forwards. They were saying that some think the higher than expected inflation could mean the Bank of England holds interest rates for a longer period of time than maybe originally predicted, whereas others are saying, actually, you know, this is kind of an anomaly, don't worry about it, and actually we'll still see base rate come down as planned later on this year. Okay, now a quick bit of rental data for you. So the Office for National Statistics says private rents in England experienced a 6.1% rise in 2023, which is the sharpest annual increase on record. Wales saw the highest annual increase in Britain at 7.1%, and Scotland was at 6.2%. London rents also escalated by 6.8% last year. Good news if you're a landlord, obviously not such good news if you're a tenant. Now, Tom Bill, who's the head of UK residential research at Knight Frank, has said, low supply continues to cause financial pain for tenants as it keeps strong upwards pressure on rents. Landlords have been disincentivised by tax and legislative changes in the past years, and there is no sign of that changing, particularly as the general election campaign gets underway this year. Political interference has had the unintended consequence of making life tougher for tenants, although we expect UK rental value growth to calm down marginally to 5% this year as the more demand is absorbed. So essentially, a very, very strong increase in rents last year, and Knight Frank are expecting rents to rise on average across the UK by 5% in 2024. Okay, now for those of you who are thinking about investing this year, and it seems to be that a lot of you are actually considering this, it really feels that landlords have kind of had a year off and now they're back in the game, as it were. Some data for you in terms of what's going on with the housing market as we've started the year. So the number of new properties coming onto the UK market for sale is 15% higher than in the same period last year. The property market is looking brighter as the new year dawns. Average new seller asking prices have risen by 1.3%, so £4,571 month on month, to £359,748, which is the biggest December to January increase in prices since 2020. Prices typically rise from a quiet December into a busy January, but the price rise is the largest for January since 2020 and more than double the 20-year average of plus 0.6%, so a big step up. However, average prices are still 0.7% lower than at this time last year, highlighting that many new sellers are being really realistic about their expectations the market continues to recover. Now, Rightmove, who are the property portal that they're referring to here, have said that buyer demand in the first week of 2024 is also 5% higher than in the same period last year, but it has also warned that competitive pricing from sellers was still vital, with the number of new properties coming to market outpacing the rise in demand. In terms of sort of more broadly market confidence, Rightmove data showed the number of sales agreed is 20% higher than during the first week of last year, which says it indicates a strong return of buyer confidence when compared to the unsettled post mini budget 1 year ago. So I think, I don't want to sort of say that we're kind of 3 weeks into the year and suddenly, the housing market is rebounded by any stretch of the imagination, but it certainly feels like we're coming into a more positive kind of phase in terms of confidence in the housing market. And once confidence returns to the housing market, as we all know, that means that prices will start to kind of absolutely bottom out and probably start to eventually turn upwards, which does mean that if you are thinking about investing, I really think that actually now could be a very good time for you, particularly when we factor in the fact that 5% rental increases are also predicted for this year. Now, I just want to share actually one more kind of bonus feature, as it were, with regards to some news that caught my eye. And this is going to really apply to those of you who do holiday letting, Airbnb, and also those of you who have any sort of second home. So the Labour-controlled Haringey Council in London has said the owners of short-term lets and furnished holiday homes will be forced to pay double their council tax for the periods of time where their properties are empty. And this is going to apply from April next year. Now, the double council tax regime will also apply to long-term empty properties, of which there are an estimated 1,000 plus in the Haringey borough, and this is also going to start from April this year. Now, the council made a statement essentially saying that they have a huge funding gap which they need to plug, and this is down to sort of 13 years worth of government underfunding and all this kind of thing. But I think the statistics are actually really kind of the thing that's quite interesting here. So what they're saying is, according to their calculations, there are currently 1,028 properties in the borough which have been empty for between 12 months and 5 years. They went on to say that they're determined to turn Haringey's empty dwellings into new homes. Londoners are in the grip of a housing crisis, and bringing unoccupied homes into use is a part of the solution. Across the capital, there are more than 34,000 empty, long-term empty homes. That's over half the number of London households that are currently homeless and living in temporary accommodation. In Haringey, we have more than 13,000 households on our housing waiting list, and last year alone we received 4,400 homelessness applications, which is one of the highest in London. So what they're essentially saying is that actually when properties are left empty, people should either pay extra money for doing that, or they're going to kind of reconsider how those properties could be put, essentially, I guess, in long term to better use. Now, the reason I think this is important is the odds are that the number of people who are watching this video who have a holiday let or an Airbnb in Haringey are probably quite slim. But unfortunately, when one council takes this position, the reality is that other councils are going to start thinking about this as well. So I think really just want to kind of put in your kind of line of vision in terms of what people could be talking about for those people who particularly are doing holiday lets and Airbnb. And that's us wrapping up for this week. So thank you as always for joining us. And as always, if you have any questions, we would really love to hear from you. 0345 345 6788. Have a super weekend. Do go and have a look at our website. Like I say, it's really, really good, and there's lots of stuff you can do on there. In addition, we've got all sorts of new calculators and case studies and all that kind of stuff. So it's really, really fantastic. I will see you again the same time next week, and until then, do take care of yourselves.